What if I told you that the IRS has a complete transcript of your tax account going back years, and you've probably never looked at it? In this video, I'm going to tell you about IRS transcripts and why they might be the most important documents you've never seen. I'm Andrew Bosserman, former IRS agent turned IRS defense attorney. Chapter 2 of my book, The IRS Survival Guide, which you can get a copy for free at theirssurvivalguide.com. Chapter 2 is about using the IRS's own tools against them, pulling your tax transcripts, spotting potential red flags early, and reconstructing records when documentation is missing. So let's first talk about tax transcripts. The IRS maintains detailed transcripts on every taxpayer. There are a couple of different types. The first and one of the most important types are tax account transcripts. This is essentially your statement of account. It's similar to a bank statement of your tax year at the IRS. It will show when returns were filed, how much tax was owed, payments, any adjustments, and any penalties and interest assessed. There are also tax return transcripts. This is a summary of your tax return as you filed it. There are also wage and income transcripts, and these are reports showing all third-party reported income or other information documents. Things like W-2s, 1099s, 1098s, any sort of third-party reporting information that's reported to the IRS. And finally, there's also another transcript type called record of account. This combines both account info and return info, although I'd recommend pulling those separately because that type of transcript sometimes isn't updated as frequently. And you can get all these transcripts for free at irs.gov. If you set up your online account, generally you can pull all of your transcripts. They're completely free and instantaneous. Or even if you can't, you can always call the IRS, fill out a form, or hire a tax representative, someone like me or another tax professional, to get them for you. And I recommend every business owner pull their transcripts at least annually, if not more regularly. And why do I recommend that? First of all, the IRS is looking at your transcripts regularly. But if there's, say, a discrepancy between your return and income reported by third parties, the IRS will find it, but you should be aware of it first. And oftentimes it's recommended to look at these information reporting documents if they're available before you file your return. Also, in my experience, most frauds could be discovered pretty quickly if a business owner just regularly reviewed their bank statements and IRS transcripts. I've seen numerous instances of where employees have been embezzling from a business by claiming they're making tax payments, but actually just writing checks to themselves and putting it in their own pocket. Now, it's a little more detailed than that. They're actually booking the payments as if they're tax payments, but the checks obviously aren't going to the IRS. Another common question that comes up is red flags. So I was an IRS agent for a number of years, and a lot of people talk about audit triggers. The thing is, most audits, you don't necessarily know what triggered the audit. The IRS has a secret computer algorithm it uses to select returns. Also, the IRS just sometimes selects returns based on projects, meaning things in, say, tax law or current compliance that they've noticed there are issues with. That could be things, recently they've gone after things like syndicated conservation easements or micro-captive insurance strategies. But a lot of, say, red flags on business returns, what I've seen audited frequently are things like large Schedule C or Schedule F losses on your tax returns, especially in consecutive years. And also when there's other income that's being offset by it. Things like high meals and entertainment deductions, high car and truck expenses, and that's really important because you must keep a mileage log. Significant charitable contribution deductions sometimes trigger audits, although those are easily substantiated if they're legitimate. And also just simple things like preparing your tax return yourself with a bunch of round numbers instead of exact figures. When I was an IRS agent, I saw that once, and it's pretty obvious that the taxpayer just estimated and didn't really know what they were doing. Now, this doesn't mean you shouldn't take legitimate deductions. It just means you need bulletproof documentation for all the deductions that you're claiming. Now let's talk about reconstructing records. So what happens when your records are lost? Maybe a fire, a flood, a crashed hard drive, although you should really be keeping things in the cloud nowadays. The IRS allows reconstruction, but it does require a lot of effort and credibility. Oftentimes you can restruct your records by getting copies of your bank statements and credit card statements. Maybe you can get copies of invoices from your vendors and suppliers. You might have copies of contracts and other agreements. Also, a good way to reconstruct, say, your mileage log, if you didn't keep one, is to go back through your calendar entries showing all the business meetings you had. Also, email is a great tool for checking and reconstructing records as well. But the key is to have a bunch of corroborating evidence. Just you saying I spent this amount of money is generally not enough. And also, there is a rule called the Cohen rule that came from a court case that allows taxpayers to estimate expenses when receipts are unavailable. However, this is just a judicial remedy, meaning the IRS generally won't allow it until you get to tax court. So it's best to be able to reconstruct based on things like bank statements or other hard documents rather than estimating expenses and trying to come up with a reasonable basis for that in court. Finally, I'd like to talk about self-auditing. As you're reviewing your tax return before filing, especially if you've had high income year or unusual circumstances, I recommend what's called a self-audit. Ask yourself, is every income item accounted for compared to your bank statements and also to your wage and income transcripts I just talked about, all those information returns. Also, do I have documentation for every deduction and do I know where I would find it in the course of an audit? In fact, just test something. So for example, find advertising expense. Say you spent $10,000 on advertising in the last tax year. Go from the return and then find that number in your bookkeeping software. So might be QuickBooks, might be Xero or another accounting software. And then you'll find all the individual transactions that made up that $10,000. Then pull a sample. You don't necessarily have to pull everyone, but see if you have documentation for all those items in there. And if you do, that's exactly what the IRS auditor will do and what I did hundreds of times when auditing tax returns. Also, you always want to check your tax return against prior years to see any inconsistencies. Is there a new income source? Is one missing? That's a good way to find mistakes. If you find errors, consider amending your return if necessary. And it's often better to get ahead of mistakes rather than letting the IRS tell you about a mistake you made. Before I go, if you found this valuable, I want to make sure you have everything you need to protect yourself from the IRS. Like I mentioned before, I'm giving away a free PDF copy of my book, The IRS Survival Guide. You just have to go to theirssurvivalguide.com. Head there now, grab your copy, and arm yourself with every strategy in the book, not just the few I mentioned. Theirssurvivalguide.com, completely free, no strings attached. Don't wait until the IRS comes knocking. Get prepared today. So if this video helped you, please subscribe and share it with another business owner you know who needs to hear this, and I'll see you in the next video.